If you financed a new electric vehicle in the third quarter of 2025, there is a greater than 56% chance you chose to lease it.
Right.
And this surge happened during a distinct rush before federal incentives expired. But examine the capital flow. The defining metric there is not the volume. It is the spread. The average EV lease payment was precisely $172 below the average EV loan payment.
And that gap is, constantly marketed as affordability. But if you actually looked at the balance sheets of the institutions funding these vehicles, it's a massive exercise in selective risk transfer.
Let's define that risk transfer because the driver still carries the daily operational friction, right?
Correct. If you lease an EV, you retain the mileage limits, the wear charges, the insurance costs, and obviously every scheduled payment.
Yeah.
What you avoid in a closed-end lease is the terminal risk.
The risk that the car is going to be worth far less at maturity.
Yes. Economically, this contract resembles a one-sided return option. It is not a literal traded put option. I mean, you aren't trading it on an exchange. But the underlying financial logic is identical.
Let me stop you there, because a phrase like traded put option might obscure the actual physical transaction happening at the dealership. Let's translate that mechanism. You are essentially saying the lease acts as return insurance on a heavily depreciating asset.
That is the practical reality. A put option gives an investor the right to sell an asset at a predetermined price, regardless of what the broader market is doing. In a vehicle lease, if the car is worth more than the contractual buyout at the end of 3 years, you just buy it. You capture that equity.
But if the car is worth less than the buyout...
Returning it is the rational economic decision. The driver simply walks away.
And the title holder, so the commercial bank or the automaker's finance arm, they receive the physical vehicle precisely when the market reveals whether their original depreciation forecast was correct. That dynamic is the central focus here. Leasing accelerates EV adoption because it protects the consumer from rapid technological obsolescence. But the financial uncertainty around, say, battery degradation or used market pricing, that doesn't simply disappear.
No, it shifts. It moves from the driver's driveway into automaker finance arms, commercial banks, fleet lessors, and eventually into the securities used to fund them. Because a cheap EV lease is not merely a price, it is a forecast.
The driver just sees a fixed monthly payment and warranty coverage.
But the vehicle's actual owner, the lessor, is taking a 3-year, highly leveraged position on battery technology, on secondary market demand, and ultimately the eventual wholesale auction price.
So if the risk simply shifts from the consumer to the financial institution, how much capital are we actually talking about per vehicle? To understand the macro exposure, we have to break down the unit economics.
Well, let's look at the residual value first. Every lease contract rests on that one crucial estimate.
Right, you start with the negotiated vehicle cost. Then you subtract what the lessor expects the car to be worth at the end of the contract. The customer pays that expected depreciation. Let's run the math on a standard $50,000 EV.
Okay.
If the lessor expects the car to be worth $30,000 after 3 years, the contract must recover $20,000 of depreciation. That calculates to approximately $556 a month.
Before finance charges, yes.
Right, before the money factor, the taxes, and the fees.
And those finance charges just represent the cost of the capital tying up that $50,000 asset. But the downside scenario for the institution does not emerge during those 36 months of payments. It emerges at maturity.
When the car goes to auction.
Yes. Suppose that same vehicle returns to the wholesale auction worth only $22,000 rather than the forecasted $30,000. The consumer handing back the keys does not pay the missing $8,000.
The lessor absorbs it.
The lessor absorbs that $8,000 shortfall entirely.
Wait, if the potential for an $8,000 loss exists on a single vehicle, that demonstrates the residual value is not just a passive estimate. It is an active pricing lever.
It is. By setting it aggressively high, the monthly payment drops. I characterize an optimistic residual simply as a delayed discount.
But for institutional investors evaluating these portfolios, we have to look at the subvention question. When a lease is conspicuously cheap, what was reduced? Was it a deliberate manufacturer subsidy, favorable tax treatment, or a reduced rate?
And most importantly, who absorbs the shortfall? To answer that, you have to transition from that $8,000 unit-level loss to how these misses aggregate on corporate balance sheets, long before the vehicle even reaches an auction.
I have the macro scale data here. Looking at March 31st, 2026, GM Financial reported roughly $24.95 billion of estimated residual value, sitting across approximately 944,000 leased vehicles.
We have to apply A crucial qualification there to prevent data misinterpretation. That $24.95 billion is GM Financial's entire disclosed lease portfolio.
Right, not an EV-only figure.
Correct. It is not a $25 billion EV loss. It is evidence of how heavily corporate valuation relies on used vehicle price forecasting.
Though the impact on earnings is already visible, GM reported declines in lease termination gains in 2025 due to falling average gains on sold vehicles at lease-end. That links remarketing performance directly to corporate earnings.
And the leverage multiplier amplifies this. Finance arms do not use idle cash. They utilize secured credit facilities, unsecured debt, and lease securitizations. A residual miss consumes credit protection. It increases the funding costs of the very next lease they try to write.
So we're moving from the corporate balance sheet exposure to the physical reality of the secondary market. We have to look at the UK industry data from 2026. The average residual value of a 3-year-old EV fell to roughly 38% of its original list price. For context, comparable petrol vehicles retained about 45%. And we saw Lease Europe issue a warning to policymakers regarding intense pressure in the second-hand EV market.
We should note that averages conceal reality, though. Performance in the auction lane varies heavily by brand, by battery size, and by pricing discipline.
But the internal friction is what catalysts these used car discounts. Manufacturers are dropping new vehicle prices, global battery cost decline, or better range simply enters the market.
I would politely push back on that, though. Lower new EV prices aren't inherently destructive. From a manufacturing perspective, price cuts expand the addressable market. They improve factory utilization.
I understand the industrial logic, but the financial damage occurs because of the sequence. Those price cuts happen as a large lease portfolio was already written using higher future value assumptions.
Which exposes the conflict between product executives and finance executives.
Right.
The product executives want volume. They want the factory running. But the finance executives want stable residuals. And software updates cannot fix physical obsolescence.
You mean the hardware limits?
Yes. You cannot send an over-the-air update to enlarge physical battery cells or change the electrical architecture. That creates a subsidized volume trap.
Which feeds into the residual value loop. This pricing instability creates a self-fulfilling cycle of margin compression.
It operates as a vicious cycle. Weak used prices lead to lower residual assumptions from the banks.
Which means higher lease payments for the consumer.
Right. And higher payments lead to softer demand. Softer demand triggers manufacturer discounting. And that discounting just leads to weaker used prices all over again.
And when these vehicles do hit the auction, wholesale buyers demand an information discount. They lack data on battery health, charging capability, and repair history.
Because they lack that data, they protect their capital by lowering their bid.
Battery health certification is no longer just a technical service. It is critical financial infrastructure. Not to mention repairability. Collision complexity and insurance costs dictate the secondary market just as much, as well as local utility, whether a second owner relies on public charging or cheap overnight charging at home.
All of which creates risk that is eventually packaged for bondholders through securitization.
Let's look at the securitization mechanics. SEC-filed prospectuses state clearly that if net sale proceeds fall below the residual values utilized in a transaction, the cash available to investors declines.
Though we need to be clear about the structure. Reserves and over-collateralization absorb those initial losses. A senior bondholder doesn't immediately take a principal loss because of one bad auction quarter.
But newer manufacturers are navigating this with very limited resale history. Take Rivian, for example.
Right. Rivian sells vehicles to Chase Bank for consumer leasing, and they contractually share a portion of the residual shortfall.
Meaning they share the liability if the car underperforms at auction? Though Rivian did note this liability was not material at the end of 2025.
It just shows that contractual risk sharing is an active mechanism in the market right now.
So, summarizing the strategic positions here, the winners are clearly the short-horizon consumers securing warranties and put options, and second-hand buyers accessing massive discounts.
While the losers are the lessors utilizing slow-moving assumptions, the volume-defending manufacturers, and frankly, investors confusing strong origination volume with sound residual forecasting.
Which means investors must track precise metrics: net remarketing proceeds, transportation and reconditioning costs, turn-in rates, extension rates, and funding spreads.
If you don't track those, you are mispricing your capital risk entirely.
Subscribe the Unlayered Global and share this with someone comparing an EV lease with a purchase. The monthly payment tells you what access costs today. The residual tells you who's underwriting tomorrow.